They also have an income. What is the property that's coming in? Properties in which the car will take you by the lift. There will be a lift to take the car right inside, and there will be a swimming pool at the backyard. You think those are needs, or it is, what is it? The market is driven by investors, people who believe that the price of what they are buying is likely to go up further. Is that right? So if there is a market for views, that market will always come with risks. Which is the bigger market? The market for views is bigger. What is your advantage in being in that market? You will get market return. Market return is the best case return. You will get the market return. Right? 2, what is it that you will get information. You will know. Right? 3, you can manage your risks. You can get out. Liquidity. Liquidity is extremely precious in investing. Right? Which means you should be able to get out when you are uncomfortable. Is that right? So suppose I say, in the interest of keeping the attention of everybody here, I have told Professor Pattabhiraman to lock the door once people are inside. What do you think will happen in the class after lunch? This place has no history of fires. Huh? What do you think you will do? You will not come, right? Suppose I have to go out. You get it? But suppose I say, I have locked the door, but the key is here. Or key is in the hands of the guy sitting next to the door, let's say. Your level of comfort will be better. Or just because there is a door, people sitting in this class are constantly going in and out. Is that what we are seeing? There are doors there, no open, isn't it? Should keep going in and out. Liquidity is like that. Liquidity is the ability to go out when you are bored, not comfortable, want to reject what is going on. Is that right? It's precious. It's very important for the investor. People keep asking investor rights. Liquidity. Liquidity will also mean lowest cost. Is that right? So how should your asset allocation be? What do you think? How should you invest? That's the question, right? We want to bother ourselves with the most. So this is one thing that happens in the market. So you have invested in the liquid markets, you have invested in the debt markets, you have also invested in the equity markets. Correct? And you are earning the market returns. You are happy with the market returns. Or you are not happy with the market returns. What's yours? What's your experience?
Happy with the market.
You don't have to tell me the appropriate answer. You can tell me your experience. What's been your experience if you've been in the market? If you're not in the market, you should consider going there. Start going there. Yeah. But if you're already in the market,
You always want to beat the no profit.
what is the problem? The problem is the moment the market becomes a market for views, what is it that happens? There are 3 kinds of players who come into the market. Who are these 3 people? Liquidity seekers, institutional investors, speculators. Is that right? Which is the largest market in the world? Largest and most liquid market in the world. Forex, $3 trillion every day. Largest market, most liquid. Have you had any time when you go to the bank and say, I want to buy dollars? Of course, there are currency restrictions in India, but saying that dollars are no longer available. You don't have that problem yet, correct? Very liquid market. What percentage of currency is bought? Why would somebody buy currency? Buy or sell currency? I'm an exporter, or I'm an importer, or I'm investing somewhere. Is that right? What percentage of this forex transaction is need based? What percentage? Give me a number. 1/4%. 1/4%. No, 1/4%. 99.34% of forex transactions do not result in delivery. 1/4% is for actual requirement of money. Correct? Why? That is what makes the markets liquid. You get it? If everybody who is present there is the one who wants the currency, he has to wait till somebody else is available to sell the currency. Is that right? So a market which is a view-based market will be filled with speculators. You get it? So what happens? Today you are going to the market and you want to sell Infosys. You can be selling Infosys because you have to pay you have an expense. You know, we've beaten real estate, so we will give that a break. Yeah. So you have your daughter's marriage to conduct, so you holding Infosys shares. So you are selling off some of it because you require money, liquidity. You think the share has now become, you know, a dividend-paying, large cash-holding company. You don't see it making growth decisions as you would like it to do. And therefore, you have decided that I don't want to be in large name, you know, technology companies. I would rather be in smaller names. So you have information, is that right? Or you have just heard that, you know, Infosys is not the same company it was before. And, you know, it is not likely to be better than the other companies. So you are selling off. How will you find out who's selling for what? You get what I'm saying? This is a theoretical idea, huh? This is called the identification problem. Right? There is a whole lot of work called market microstructure, how to structure markets, right? So in market microstructure, one of the important ideas is may know something which you do not know. You are operating in a market of that kind, right? And there can be cycles and bubbles in the market where prices will move ahead of themselves, right? We know of many of these stories, and companies which are doing very well at one point of time may not do well going forward. We call this creative destruction. A business has to continuously deploy assets profitably to remain on the top. Very few businesses have done it. I remember in my postgrad days, you know, there used to be this book, In Search of Excellence. Top 25 companies. Only one is surviving today. Good to great, built to last. None of these lists have lasted. Because no one still knows what is the formula for the most successful company. Is that right? So when you are investing, it is important for you to remember that what you have bought can go back. It's very important. Do not make that condition that I will buy. You know, we make long term look like it's a very virtuous thing. I will buy and I will hold long term. Reliance Power investors are holding with the same fond hope. You know, one day the company will become good. So it's important to remember that there will be creative destruction. I remember 1985 when the first market boom that I witnessed, which was the top company in the market. The one company which used to drive the market. ACC is 912. ACC was loss making, no? No. Century Textiles. The market began with Century and closed with Century. Who was the biggest player in the market? No. No, LIC never bought equity shares. UTI. UTI was the only institutional investor. Market would open with what trust has done and close with what trust has done. The only player in the market with large amounts of money investing in equity shares, 65,000 crores. Those days it was a large amount of money. Yeah? Nobody else bought. IFCI, IDBI and all of them will only have equity shares which were converted from the bonds that they had issued. LIC also, LIC's board allowed them to only buy. They were not even allowed to sell. It was in 91, after a lot of struggle, they got permission to sell 10% of their shares. You know, so no one was selling. So markets were like that, correct? So if you say, you know, Sensex, people are saying, oh, you must buy the Sensex and hold it for the long term. Nothing will change because you are holding for the long term. Huh? So you bought the Sensex and you held it. Held all the companies in the Sensex. What would you be holding today? Premier Automobiles, Hindustan Motors, Gujarat Narmada Valley Fertilizer, Bombay Burma Trading Corporation, Century Textiles, Wimco Matches. You think these are blue chip companies? So there is nothing like, you know, sitting quiet, doing nothing and making a lot of money. It doesn't happen. So when is money made in the market? So that's what happens. And there are limitations. I'll talk to you about the limitations in a while. So before we make an investment product choice, what is it that we should know? We can go wrong. What is our defense against going wrong? We can choose with the best analysis, but we can go wrong. We can choose the companies that we have chosen. So we must be able to throw out what is not working. If we do not have that ability, money in the bank is the best choice. if I cannot question this is not doing well and I do not want to hold it, right? Then you will not be able to make your investment decisions. Is that right? So what is the first step in the investment decision? Asset allocation, right? So where should you start? I'm giving you a big version on markets now. So you shortchange your money if you're not in the markets. You seriously shortchange your money if you're not in the markets. And it's criminal that pension money in the provident fund is invested in income assets, right? In the debt markets. Because there's an ill-informed government and a provident fund commissioner, right? Who puts long-term money in assets which will not even cover inflation, right? Just that, anyway. So how will you invest? Many of you told me that you're in the class to know how to invest. Tell me, how will you invest? So you will first begin by asking how much is your liquidity need, how much is your income need, how much is your growth need. That's your basic asset allocation. Is that right? So how much is my liquidity need? What does that do? What is that based on? Your liquidity need will be high if you do not generate regular saving surpluses. Till such time you reach a point in your life where some money is lying in your savings bank account at the end of the month before your salary comes. You have not proceeded beyond liquidity. Don't try other things. It will make any difference. You should be able to have a regular surplus because your primary liquidity need is met by what? Your income. If you have an income which is unstable, which moves up and down, what should you do? You must provide for liquidity to take care of the down periods in your income, right? If there are seasonal incomes. Or when else will your liquidity need be high? Emergency, as long as your assets are liquid, it doesn't matter. When else will your liquidity needs be very high? You have a large expense which is to be met, which cannot be met from your salary, right? So if my daughter is getting married in another 3 months, my portfolio will be liquid in the next 3 months because I have a large amount of money which has to be spent soon enough. Is that right? So there is a need that is coming in. So what is the normal thumb rule? People were asking me for thumb rules. So what is the normal thumb rule? How much of your money should be in liquid assets? You tell me. See, 6 months of your income, all of these are financial planning components. You can keep them. You can use them if you like. But all your investments and bonds can be liquidated as well. They won't classify as liquid assets. Pure liquidity needs of adjustments, transactional adjustments, right? Whenever you need money, you take it. Whenever you don't have money, you push it back. Is that right? That's your liquidity. Not over 10%. Not over 10% of your money, right? What will you do when there is an emergency? You will have assets, right? You will use those assets to raise money. Correct? You will have income assets. Is that fine? What should you do with the rest of the money? How much money in income assets? How much money in growth assets? What are the, as I told you, overnight money, right? There are a whole range of funds which are called the ultra short-term funds. Is that right? What you should do, look at the fund's fact sheet to see where it is investing. If it is investing in money market instruments, that is your fund. Correct? So this is investing in the CP, it's investing in the CD. You will find that all fund housing are given to these products, but essentially what should you look for? A product which is investing in money market and a product which has no exit. Right? It will give you market returns. The typical cost for a liquid fund will be anywhere between 25 paisa to 45 paisa. Correct? So if the return on the market is 8%, after this 45 paisa, the remaining money is what you will get on every rupee, every day. Every rupee you have invested, for every day you have invested. Right? So that's the way you can put your money in the market. You will get your money after 1 day. A liquid fund is a good way to start mutual funds. If there are people here who do not do mutual funds, I don't assume there are people here of that kind. But yes, it's a good way to start because you will get to see how your NAV moves, how your return can be stable, and what happens to the money. What is the other choice that you have? Savings bank. You also have 1 year bank deposits. If that's your point of comfort, you have 1 year bank deposits. Except that interest is taxable, your actual return can be lower, can have it. And then of course you have your own locker in the house, cash, no returns. Right? As long as the money can be accessed quickly, you should be able to don't allocate more than 10% ever. 10% is still higher. Imagine a portfolio of 15 crores. Would you think a 15 crore guy is leaving 1.5 crores in the savings bank account? Very bad investment decision, right? So your investment in liquid funds will be to the extent that you need money for adjustment. Is that right? So unstable surpluses is an indication that you have liquidity requirements. Is that right? Bonds. How much will you put in bonds? How much will you put in equity? What do you think? What is the correct ratio? Correct. Okay. What else? If you have a salary, you do not need any income investments, no? Do you? You are the asset generating income, isn't it? And that itself is generating a surplus. So why do you need income assets? What does it have as assets? So the company has fixed assets of about 23,000 crores. Funding it. All assets will have to be funded, right? One way or the other. I told you about the Panwala outside, right? So who was funding him? He's giving away, selling off on credit and increasing his business. What does he need by way of backing it up? Either he brings his own money for buying fresh stock, because the sales proceeds from the stocks that he has sold is not coming to him. It's coming after 30-day delay. He's giving a 30-day credit. Either he needs a 30-day supplier's credit. Right? Whoever gives him the raw material should also tell him, you pay after 30 days. Or he needs a bank which will look at his stocks and say, I will give you 30-day credit. Or he brings his own money. Correct? All assets in every business will have to be funded, and here you will find that there are long-term, there are inventories, and therefore they will require funding, and that probably explains the high amount of assets. So this is where we are as far as the structure, the broad structure of the balance sheet goes, and I'm taking you to the profit and loss. Okay. I hope you remember the assets, right? How much was the assets of the business? 30,000 crores, correct? What is the sale? To raise alarms or not? You have to find a way of bringing these together, which is what I today am going to discuss one number with you, which is ROE. You will ask, how does the business, it's not about, equity investing is not about stock numbers, it's about flow. How things happen over a period of time, correct? So, when you look at a business and ask, how will it return money to the equity investors? The business has to do three things. To be a worthwhile investment for an equity investor. What are those three things it should do? It should essentially be profitable, which means it should have a positive margin, correct? Why? What does the margin do? The margin is your return, correct? Return on the investment, so to say. Whatever is the investment you have made in the business as an equity investor, there should be some return on it, so it should have a margin. It must have a profitable margin, correct? One. The second thing that it must do, in order to make this profit, let's assume that there's a new business which is making a lot of profit. On the assets that it has created, on every sale it makes a very decent margin. What would happen to such a business? It's good to ask questions to a post-lunch class.
More players.
You're very valiantly awake, but still. Yeah.
More players will come.
Yes. Competition will come in. What do you think competition will do first? Cut price, right? So, your margin is the first one that will come under attack. You get it? Competition will come in and they will start cutting prices. Margin will come under attack. What will you do typically to protect your business? You will acquire size, is that right? Internally, what will you say? You will say, look, I am profitable. You will go to venture capital investors and say, I am in an essentially profitable business. You give me 100 crores to build more assets, I will build scale and I will become bigger. If I become bigger, I will be more resilient and I will be able to ward off competition much more than, better than I am today. So you cannot keep increasing margin margins over a period of time without building assets. So you will invest in assets. What happens when you invest in assets? When you invest in assets, depending on the nature of the business, what would happen? The time taken for the assets to convert into sales